WeWork's innovation and corporate innovation and entrepreneurial hub. We support early stage startups and forward-thinking corporations. We do that by giving you access to mentors, helping you raise investment through introductions to investors. We have a satellite program which essentially enables any startup company within labs to access our global innovation hub. And that's 75 locations, which you're going to basically come in, have a dedicated desk there. And what's really cool about the program is we don't take equity in the companies. So we really see this as a simplistic, transparent business model where we want to help early stage companies grow, raise capital, build out their team sizes, and then essentially be based and have occupy more space in WeWork. So it's a great honor to bring the founder of Startup Grind onto the stage, and you've got a really exciting evening ahead of you.
Yeah, put it here.
Hey everyone, my name is Derek Anderson. I'm one of the co-founders of Startup Grind, and it's great to be with you virtually tonight. Welcome to this live event being hosted in London and being streamed across the world. We're really excited to have Scott sharing his experience as an operator and as an investor at Andreessen Horowitz, and grateful to have him in London. Also, a big shout out to Heroku, who's making this whole month possible across the world as we have these events happening in dozens of countries. On a monthly basis, we host around 200 events in 200 different cities. And so we're thrilled to have this together as a sort of opportunity for us to sort of gather both virtually and in person in many spots tonight. But really, Startup Grind, which we started about 10 years ago, was founded in order to educate entrepreneurs. Our mission is to educate every entrepreneur in the world, and we do that through building local communities. We have about 600 local communities today. If you are trying to get educated, if you want to meet people and network and get sort of elevated inside your community, you should start a chapter, or you should join the leadership team of your local chapter. And we connect all of these cities and all these people around three core values of making friends, helping first, and giving before you take. And so I hope tonight, if this is your first time Startup Grind, I hope you have a wonderful experience. I hope you meet someone interesting. Hope you help someone sitting next to you. Try to find ways to help other people in the room. If you're joining virtually, please go on Twitter and share the insights that you have. Try and help someone else by sharing something that Scott mentions or talks about, and something from his book. Go buy his book and send it to an entrepreneur or send it to a friend who you think needs it. But grateful to have you here wherever you may be around the world. Hope you have a great rest of 2019, and we hope to see you in Silicon Valley at our global conference in February, which marks the 10-year anniversary of when we started Startup Grind. And so we hope to see you then. But if not, wish you well and have a great evening.
So this is the founder, Derek Anderson, and quick show of hands, how many of you are here for the first time? Okay, how many of you have not heard about Andreessen Horowitz before today? One, okay. So this is a good place to learn more about them and what they do and how do they choose these amazing startups to invest in. They have an amazing track record, and I don't want to bore you for too long because this is super exciting for us. We have people watching us from all over the world. We hear later from where. So please, without any further ado, join me in welcoming Scott Kupor from Andreessen Horowitz and Thorold Barker from the Wall Street Journal.
Thank you.
Good evening, everybody, and welcome to WeWork. My name's Thorold Barker. Oops, a little wobbly. And I'm the editor for Europe, Middle East, and Africa at the Wall Street Journal. And I'm super excited to have Scott Kupor here, managing partner at Andreessen Horowitz and also author recently of the book, The Secrets of Sand Hill Road, Venture Capital and How to Get It, which I think is why you're all here, or many of you are here. Could you actually, just in the spirit of showing hands, how many of you are here specifically because you are interested in raising money at the moment? Okay, so hopefully you're going to have lots of questions later about how to go about that. But Scott should know all about this because he has been at Andreessen Horowitz for about 10 years. He's taken it in that time from 3 people to 150 people, or more than 150 people, and from $300 million assets under management to 10 billion. They've also invested in a few companies you might have heard of. I think Facebook, Lyft, Pinterest, Instagram, Slack. I'm sure there will be others that come out.
That's a good list.
So he knows what he's talking about. So please throw up questions. That's part of the reason we're here today. Also, we are being live streamed around the world. Marian just gave me a list that he wants me to give you a flavor of. We are live in Baku, Vancouver, Auckland, Beijing, Montreal, Oslo, Warsaw, Florence, Edinburgh, and Hollywood. So the last being the most exciting, I think, probably. Anyway, if you're out there on the live stream, if you go to slido.com, you can add a question, #startupgrind, and it should appear on the screen behind us. So we will go to that as we go along. So before we dive into how you get money off Scott, I just want to start with a slightly higher level look at what is actually going on in tech and venture capital right now. We've obviously had huge amounts of money raised in recent years. We've had companies that have grown incredibly quickly. And we've also had some companies that have got into a spot of bother recently, including, thank you for hosting us, but including WeWork, where obviously huge amounts of money have been raised, huge amounts of growth, but recently the IPO was delayed and obviously some changes of management at the top. So will you just give us, Scott, a quick sense of, where do you see the industry now, and particularly compared with the one you came into 10 years ago?
Yeah, so first of all, thank you for doing this tonight. Thank you to Startup Grind. Thank you to WeWork for hosting us, even though we may not get invited back after this question. Let's talk a little bit high level, kind of where we are and what's happened. So if you think about the venture industry, I think there's probably one of the most foundational things that's happened over the last 10 years is exactly this phenomenon of companies staying private longer and therefore lots of money kind of in the private markets. The numbers, just so you have a sense, so it used to be historically over kind of about the last 30 to 40 years that it took about 6.5 years on average for a company from founding to go public. Today, it's between 10 and 12 years, depending upon kind of which data you believe. So there's been this very demonstrable trend, effectively doubling of the time that companies spend in the private markets. And we can debate how we got here. I think it goes back, there's a lot of capital markets issues and stuff that we can talk about. But the phenomenon is real. And what's really happened, I think, is as a result, therefore, particularly in the US markets, you've basically had public dollars coming into the private markets. Because growth essentially, in some respects, has been outsourced to the private markets. So you've had mutual funds and hedge funds, private equity firms, a bunch of them, essentially putting money into companies that otherwise would have been public at another time. So that's kind of one big trend. There's the bigger question, obviously, which you bring up now, which is, okay, what do we think about what's happening now, particularly in the wake of what we've seen? And I think there's kind of, the way I would describe it is there's kind of a tale of 3 cities, if I can, not a tale of 2 cities that you might have read about at one point in time. One is traditional, kind of what I would call enterprise software businesses where the business models are relatively well understood. We know at scale a software business is going to have high gross margins, it's going to have good operating margins. And if you look at how those trade, both in the IPO market as well as more broadly in the public markets, they're trading at very, very healthy valuations, right? And people can debate whether they're too healthy or not, but it's certainly that those trade well. Then I think you've got a second class of companies, which is kind of higher cash burn, high growth, but higher cash burn companies. And if you look at those, they certainly don't trade as well. There's no question about that, right? Even the ones that have gotten public have not traded as well.
So you mean Uber, Lyft?
Any of those companies, right, where you don't have kind of near-term visibility to profitability, right? And I think the explanation for that is largely a function of if you believe we're in late cycle, which we can talk about and debate. My personal view is we're not, but we can talk about that. And given all the volatility that's happening in the markets, particularly in the U.S. markets, where you have a lot of the kind of U.S.-China tariff issues overclouding the markets, you would expect that companies that don't have kind of near-term visibility to profitability probably will not trade as well, kind of all other things be equal. So I think that's kind of the second part. And then I think the things that we've seen over the last couple, kind of weeks of WeWork is a little bit of a class of its own. Because I think it combines a lot of those things in ways that we haven't seen before. So I think you've certainly got kind of that middle category of, relatively high cash burn, obviously, which, again, in this environment, I think gives people pause. But I think you've got two other issues also that made it a challenging offering. One is just the governance structure. Yep. And look, we've been experimenting,
well, let's
say.
Go into governance in a minute, because I want to just break this into two very quickly. One is the money, and then we'll talk about the people and how you run a company and the culture. But from a money perspective, obviously you've just raised a $3 billion fund, is it? Or two funds. Two funds for the $3 billion. So that's a big number for venture capital. Obviously, SoftBank Vision Fund was 100. So that's a massive number. Is there just too much money, and has that made valuations wrong, for want of a better word?
Yeah. I don't think so, and let me try to make the argument for why I don't think so. So I think you can't divorce that from the context that we were just talking about in the first instance, which is this idea that essentially you have a bunch of money that otherwise would have been invested in the public markets, and these companies now coming to the private markets. So that, I think, is a major sea change that we haven't seen before. The other thing that's happening, right, is we know that the end user markets are bigger than they have ever been in the past. So, a story that I always like to recount, Mark Andreessen, one of our founders, they sold Netscape to AOL in 1998. At the time, the entire addressable global internet user base was 147 million people in the world. That was the entire, internet base. And for those of you who are old enough to remember, you had literally these horrible dial-up connections, right? It was not a pleasant experience to basically be connected to the internet. Today, that number is 4.3, 4.4 billion, depending upon how you slice it, and we're all walking around with effectively supercomputers in our pockets. Now, that doesn't mean that every company can be of the scale of Facebook, but it does mean that when you win, the opportunity to win is much greater. We can have $500 billion, we can have trillion-dollar market cap companies that I don't think anybody ever imagined we might have. So I think there's no question, yes, you have a lot of capital coming in, but at the same time, I think the market size for the opportunities is much greater, and you've got kind of this strange thing which we've never seen before, which is effectively growth happening in the private markets that used to happen in the public markets.
But we're also seeing a company, and the Vision Fund would pretty explicitly say this, that thinks they can pick winners by just putting so much money into them that no one else can compete. I mean, has capital become in itself a definer of who wins and loses, or is that just not correct, and actually the other skills of VCs are still as important as they always were?
Yeah, I would argue that at least in the US, and let's start there, the ability of SoftBank to do that was much greater probably 4 or 5 years ago, kind of when they first really in earnest started deploying the Vision Fund, which was probably 2015. And the reason for that was there was no other player who could write checks at that scale, right? So, we still don't have anybody who's got a $100 million fund other than SoftBank, but there was nobody else who could write at that scale. Today, you've got private equity firms, so firms like KKR, TPG, and others. Those people can write $250, $500+ million checks. The mutual funds are there. The tech hedge funds are very active. We're seeing a lot of sovereign wealth activity at that end of the market too. So I think the ability to kind of king make as a result of financing is actually much more mitigated today than it might have been even 4 years ago.
And just final thing on this, is your sense that that has pulled people into the market who aren't as sophisticated or knowledgeable as they should be, and that mistakes are being made because of that?
I don't think it's...
I mean, you cited sovereign wealth funds, for example, who aren't typically known for their venture capital investing skills.
Look, I think it's a different... So I think there's two things happening. One is those players have a different cost of capital than do the venture capital firms, right? So in our business, right, for us to be successful over the long term, we have to return very high cash-on-cash returns to our investors. But if you're a sovereign wealth fund, or if you're Fidelity or T. Rowe Price, if you can underwrite to call it like a 15% net IRR, then logically you will pay a higher valuation than somebody like us will. So I wouldn't ascribe it to be lack of financial sophistication. I would say they have a different cost of capital and therefore a different hurdle rate they have to exceed. And so I think that's why you do see higher valuations there, but they're consistent with how they think about kind of comparable public opportunities.
Okay, so we'll get on in a minute to how you choose, how you deploy your capital. But just going back to your issue of some of the management challenges that happen both at Uber and at WeWork, what are the lessons that you would give to people in this room and on the live stream for what to avoid. Because on the one hand, those founders were incredibly successful at driving growth and building these businesses, but at the same time, there were obviously cultural challenges that developed that have caused huge problems as they got to a certain level. So what are the lessons for people starting out and building their businesses of how to think about balancing that culture?
Yeah, no, I think it's important, and let me just kind of point out one other thing as it relates to that before I answer the question directly, which is another big change that's happened in the venture business, again, particularly from a U.S. perspective, is the nature of governance and the nature of control of boards has changed dramatically, right? So for most of the history of venture capital, either the venture capitalists controlled the boards, meaning there were more board seats they had relative to the founders, or you had kind of what would be kind of balanced boards where you might have some common shareholders, some venture capitalists, and then some independents. Today, I don't know if this is factually the case, but I would venture to say that probably 75% of the companies in Silicon Valley that have been funded over the last 7 to 10 years have boards that are controlled by the common shareholders, meaning the founders, right? So if you think about what that means, that's where you get these situations like an Uber or a WeWork. These are not
just
simple.
Too much power in the hands of...
Well, yeah, so the board, right, the fundamental job of the board ultimately is to hire or fire the CEO, right? That's probably the most foundational thing they do. And when you change this governance structure to where you can't really fire the CEO because the CEO effectively controls the board in that respect, it really changes how you think about governance. And so this is why you get these kind of very high kind of showdown type activities happening in the public sphere, as opposed to a lot of these things would have happened in the past kind of, behind the scenes in terms of, these would have been board discussions that would have happened before. So look, I think all these things will probably, we've kind of shifted from one governance structure extreme to another, right? Did we lose our background?
We lost our questions. Yeah.
Hopefully they're coming back, or somebody wrote them down. We've kind of shifted from one extreme to another, where for most of the history of venture capital, the venture capitalists, controlled the boards. Now we've kind of completely flipped where more of the founders control the boards. My sense is, as with all things, is we will moderate somewhere in the middle over the next 5 or 10 years and have probably a governance structure that probably more accurately reflects what's actually happening in the market.
And when you look at, when somebody comes into your room and talks to you, I mean, obviously the answer is both, but I'm just curious how you sort of balance the two. Are you looking for the founder and their energy and their sort of ability that you see, or is it the idea? I mean, how do you kind of balance those two things? Because...
Yeah. So look, at the early stage, a huge part of our evaluation is going to come down to the team and the characteristics of the dynamics of that founding team. And if you go back, right, that starts from the presumption that we know these markets are going to be incredibly, if they're big markets, they're going to be incredibly competitive, so we're likely to have multiple players in the market. And so the fundamental question often becomes, what is it about this team that makes them uniquely suited to go after the opportunity that would cause you to invest in this team versus any of the 5 or 10 others that might walk through the door over the next 6 or 12 months? And so, yes, you've got this weird conundrum, you're right, which is we want kind of both things, which is you want the kind of, cocksure, independent, forward-thinking founder who believes that, nobody can tell them anything that's wrong about their business. And then you also need, at some point, you need some personality also that is at least willing to listen. What is the market telling them? Kind of, are they doing things in an appropriate fashion? And so these things often are in conflict, and this is the challenge, I think. You can't unfortunately, you can't take the good without the bad. We have a phrase internally that we talk about in the firm, which is we invest in strength, not lack of weakness, right? So, and what I mean by that is, look, there's 100 reasons why you would reject a company. The question is, are the strengths strong enough that you're willing to tolerate and deal with, obviously, some of the negatives that may come out, and sometimes that works, and sometimes it doesn't.
So very quickly, is an MBA a good thing when someone walks through your door, or is it like, actually, it's going to constrain their thinking? I mean, do you have a preference either way, or would someone be better off spending 2 years cutting their teeth doing something else?
So I tweeted an article this morning. There was an article, actually, I think in your esteemed paper, talking about that MBA enrollment and applications.
That was our most read story as I left.
Is that right?
Yeah,
well, that's because I tweeted it. That's why it was most read. And my tweet, which is a little bit tongue-in-cheek, is there's a big, the big explanation right now, of course, in the U.S. is that because of our immigration policy, obviously, that international applications are down, which I have no doubt is true. But I think there is a broader question, which is kind of, is the full-time kind of MBA program, will that be with us 20, 40 years from now, or, whether people believe the opportunity cost makes sense. I think in the entrepreneurial world, look, there's valuable reasons to go get an MBA. I don't think anybody's making a decision to fund or not fund a company based on whether you have an MBA.
I'm going to get to what you guys care about, I promise, but I just want to ask one more thing. When you look around the world, Silicon Valley is still the center of what's happening.
Yep.
How do you look at places like London and obviously some of the places that are listening around the world? I mean, is that beginning to change? Are there more opportunities? And do you as an investor, are you more willing to deploy capital in places that you weren't 5 years ago?
Yeah, look, it's absolutely beginning to change. So here's a very simple way to think about it. So 20 years ago, the U.S. represented 90% of global venture capital dollars. So literally nine out of every $10 in venture capital in the U.S. Today, that number is 50%. So over the last 20 years, you've essentially had a 40 percentage point, kind of margin shift from the U.S. being effectively the only place for these startups to now essentially the U.S. is barely, a majority of kind of global venture capital dollars. I don't think there's any reason to believe if we're sitting here 10, 20, 30 years from now that trend won't generally continue. Now, I don't think the U.S. is going to be negligible, but at some point in time, you would imagine that the amount of venture capital financing and entrepreneurial dollars should roughly approximate the global GDP contribution of these countries, because we have, the world is very flat. We have lots of kind of talent in lots of places. We now have seed infrastructures in lots of markets, which I think is the critical piece. I think it's very hard to outsource seed to another geography. And so now that we have great infrastructures in places like here and, Africa and China, other parts of the world, I don't think there's any reason to believe that we won't see kind of that market share shift continue to happen over time.
So one of the questions behind us says, will you open an office in London? So are you willing to put your money where your mouth is in terms of the opportunities overseas?
I believe in a virtual world, so I'm not sure we have to have an office here, but maybe after Thursday,
You could use WeWork.
After Thursday we can answer that question.
You could have temporary space in WeWork? That would
Yeah,
be...
exactly. Yeah, so look, we have not, we don't have an office here, not because it's a normative statement, quite frankly, on the opportunity here. We don't have offices anywhere outside of Silicon Valley. Part of that is just our business model, which is, as you and I were talking about, we have a very kind of heavy engagement with our companies. So we have about 180 people in the firm, and 100 of those people work with our companies post-investment. And so for us to come to a place like London and do it in a brand consistent way, we can't just drop an investment partner here. We would want to figure out how do we support those companies long term. And that's not impossible for us to do, but as a relatively young company, we still feel like, look, we need to perfect the model here in the market that we understand. And then I think, over the course of the next 5 or 10 years, it's more likely for us to then say, okay, are there other markets where we can now kind of transplant that model?
So what is exciting for you at the moment? I mean, if you look at, let's forget geographies for a minute, but look at sectors. You talked about enterprise software, for example. I mean, where are you seeing the most interesting opportunities?
Yeah, there's a couple areas. I'll answer your question, then I'm going to give you maybe a non-answer to your question as well. So
let's stick with the answer. But
you want the answer first? Okay. So look, there's a couple of areas we're spending a lot of time. The intersection of life sciences and computer science is definitely a very big area we're spending time on. So think of that as companies building new diagnostics or new ways to try and cure diseases where they're not just relying on traditional wet lab biology techniques, but they're also using things like machine learning or other forms of artificial intelligence to not only hopefully, take some science risk and turn it into engineering risk, but also to hopefully create platforms over time. So that's a big area of investment. We have a separate fund focused on that. We're spending a lot of time in what I would call kind of core enterprise infrastructure, which sometimes doesn't get a lot of billing because it's not as sexy for people to talk about. But think of kind of everything from SaaS applications on the top end to APIs and databases and analytics and things of that sort. There's a huge amount of activity happening there. And then another area where we've been investing quite a bit of time of late is in the crypto space. So we raised a fund last April and are still kind of actively investing there. So there's a ton of other stuff. We do a bunch of fintech, we do a bunch of consumer stuff, but I'd say those are probably the 3 biggest growing areas, at least on a relative basis within the portfolio. And then the non-answer to your question, which is actually not a facetious answer, is I don't think we're smart enough to know exactly what the kind of next hot thing will be over the next 5 or 10 years. And so we think of ourselves largely as we are software-based investors. That's kind of the main theme that we focus on. And we really are in the talent business, which is we need to be open-minded enough to go see where is the engineering talent going, what are people doing, what are they building, and we have to then figure out, does the intersection of software with that industry make sense? So it's quite possible that what we will do over the next 5 or 10 years is very different from what we're doing today, with the one exception that software will be the foundational technology element.
So there's a question I think is relevant here from Vlad. Data is one of the bottlenecks for AI. What is your perspective on data labeling and data gathering companies?
Yeah, so we're still experimenting, to be honest. So we're trying to approach it in 2 ways. One is, can we use data and AI to help kind of the sourcing problem? In other words, to kind of find good opportunities. And then the second piece is, can we use data or AI to help us actually in the diligence process? Right now, we're kind of focused more on the latter and trying to figure out, again, are there things we can do in terms of data gathering that might help us determine, okay, once we are interested in a company, can we actually figure out based upon the data, does it make our diligence smarter and hopefully make us better investment decision makers? We haven't yet solved the kind of top end problem, which is the sourcing problem, but we're doing a bunch of experimentation. But as of now, I would say it's a relatively small part of what we're doing.
Okay. So let's go to the individuals, because we have a lot of individuals in this room. What is it that works when somebody's pitching you? I mean, can you try and give some examples of situations in the past where people have really made something that on paper wouldn't have been that exciting and really brought it alive and made you engaged? And the more kind of color, the better.
Yeah, so I talk about this a little bit in the book, but let me try and articulate it. So we talk about this concept of storytelling as a very important part of the pitch process, right? And so what I mean by that is kind of the good storytelling, not kind of hoodwinking people by making things up, but the idea that can you convey kind of your enthusiasm for the project, your kind of vision for the future that ultimately, quite frankly, causes people to potentially do unnatural things they wouldn't otherwise do, right? So why am I going to go home and tell my spouse I'm quitting my job to go work for you? I'd only do that if you were able to effectively have an incredibly compelling message, and that message has to be not just what the market opportunity is, but it has to also be how did you come to the opportunity? How did you decide it makes sense? What is it that uniquely kind of situates you to be able to kind of take advantage of this opportunity? And I think people sometimes forget that, and the pitches can sometimes become a little bit more rote. It's like, look, let me take you through the market size. Let me take you through the product.
So give me an example of someone who was brilliant at that. I mean, you've had a lot of very successful companies. Is there someone you can point to? Yeah,
look, to me, like one of the most interesting ones is, let's take like Lyft, for example, right? So what they did a great job is at the time, Lyft was obviously, effectively, pioneering the car sharing business. And what a lot of people did, or a lot of people reacted to kind of what you might have heard from them, was to say, okay, look, this is really interesting market, but it's probably just a taxi equivalent market, right? So let's kind of size the opportunity based upon the taxi size. So at the time, actually, I remember this, the total receipts for taxis in the San Francisco market was about $100 million when we were first looking at Lyft. If you look at Lyft and Uber combined today, they do each about $1.5 billion in San Francisco. So what the Lyft founding team did very well, and ultimately which got us to invest, was to say, look, you're thinking about the market in the wrong way, which is you don't size these things based on, kind of can we win some fraction of the taxi market. The question is, do you believe that technology can enable effectively a new market to develop in a way that didn't before? It's the same way the Airbnb folks, think about kind of the housing market, right? If you remember that, it was literally people sleeping on other people's couches. And there was a business, couch surfing, that had never really taken off. But again, their view was, look, that's not the business. The business is, imagine what would happen if people who don't travel today can travel because we create a new, financial incentive for them, or people who don't otherwise have disposable income would do things they wouldn't otherwise do. So it's that type of storytelling, right? Wrapping the investors' kind of, eyes and ears around what the scope, it's the what if question, right, that I talk about a little bit, which is imagine everything goes well. What could this possibly look like? How big could this be? How exciting of an opportunity could be? And I think that's the job of the entrepreneur, is to paint that picture.
Fascinating. One of the questions behind me, I think if it's still here, is about WeWork. And actually, interesting, they're saying, did you have the opportunity to invest? I would sort of ask it a little differently and say, did Adam Newman ever pitch you? And he's obviously quite visionary and has persuaded a lot of people to put a lot of money behind that vision. Did you ever have him pitch, and what did you think?
Yeah, so I'm not trying to be evasive. I never saw it. I think some of our partners did see it. It never got to, we kind of do several rounds often of pitches, and so it's possible that I might have not been there, but I don't recall it ever getting to kind of the final stage where we were ultimately making a decision. But that's true of a lot of things. We see a lot of deals over and over again, and very few of them obviously get to the finish line.
So let's just turn it around to coming from that side and choosing whether you are the right people for them to go with. Right. There's a question here I think that is relevant here, which seems to have vanished. Okay. But anyway, it was really about how should they, if there's all of this money out there, where money for a good idea and a great founder is not the issue, how should they think about who they go with? Who do they take that money from? Should they, and just give us a sense of how that decision, and what you should be looking for in a venture capitalist.
Sure. Yeah, so look, I think you have to treat it the same way as you treat any long-term relationship. So I don't know if this is true in the UK. In the US, it turns out that the average marriage lasts about 8 years, which is actually shorter than the average VC relationship in the US.
What is the average VC relationship?
Well, probably call it 10. If in the success case, it's going to be 10 plus years, right? Obviously, in the failure case, it could be a lot shorter. So I bring that analogy up. I don't want to strain the analogy too much, but look, you wouldn't, just like you don't get married by, just like you date somebody, you get to know them kind of leading up to the marriage. I think you got to think about.
And it shouldn't just be about their bank balance, presumably, when you get married like that.
Well, that's right. Yeah, right. There are, right. Hopefully, you are trying to find out what makes them a good long-term partner, right? That's your main criteria. But I think you have to think about the VC relationship the same way, which is, okay, look, is this somebody who you think you can learn from, who can help you develop and grow, and for whom you actually want to enter into a 10-year relationship? And what, at least for us, that means is, okay, has that person kind of been through the gauntlet you've been before? Do they understand the company building process? Do you think they can be a good coach, mentor, consigliere to help you kind of manage through it? And then, the other piece that we've done, obviously, at our firm is we put a very big investment on building out post-investment teams, so helping our companies with everything from sales and marketing opportunities to talent opportunities. And that's not the only, there's plenty of other ways people can differentiate in the market. But I think what's happened in the business over the last, again, 10 to 15 years is it used to be that capital was the scarce resource. Basically, capital was scarce, the VCs had it, and therefore, that was really the primary kind of criteria that entrepreneurs were deciding on. Now, it's completely flipped, which is capital has become a commodity, and therefore the entrepreneurs, quite frankly, are in a great spot where they have choices now of financing sources. And I think you have to think about what do you value other than money, because there's always going to be someone out there who's got more money and a lower cost of capital. So the question is there some other value add that you think as an entrepreneur can actually be helpful in building your business?
And how often do people actually go with venture capitalists at a lower valuation, giving away more equity because they have that chemistry or that view that they're going to get more value out of it?
Yeah, so I want to be clear. I'm not suggesting, and look, I don't want to speak on behalf of the entire venture capital community, but I'm not
how many times have you seen that? I mean,
yeah. Look, you should demand as an entrepreneur, and we need to give you a deal that's fair and that represents kind of where the market is. So look, there's always going to be some differences in valuation because different people may see the company differently. But yeah, look, I'm not suggesting that you should just automatically say I will take kind of a valuation that I believe is out of market that doesn't reflect kind of where the business is. But I do think at the margin, what we do see is people do consider that and they say, okay, look, as long as this is kind of fair, it passes the red face test, if I believe this firm can actually add value to me that's different from some other firm, then yes, entrepreneurs are willing to do that. Now, I think as you get later and later in the cycle, the willingness of that probably changes, but certainly at the early stage, we certainly do see that activity.
Okay, I'm just going to go back to this one at the top just very quickly. Love that you invest in first-time entrepreneurs. What common traits do they share?
Yeah, so we are very happy to invest in first-time entrepreneurs, and it's actually part of how we built the entire firm was to create a firm that enabled us to do that, which is why we have kind of this big post-services investment, or post-investment services, excuse me. So what do we like? It's all the things we've talked about a little bit, which is, I'll give you a couple concepts we look at. One is kind of what we call founder market fit, right? You've all probably heard of product market fit, right? But founder market fit is, again, the concept which is, look, what is the fitness between the idea and the market you're going after and the particular characteristics of this founder? So it could be that it was your PhD thesis that you've studied for 10 years, or you had the problem and just kind of set out to solve it and almost felt compelled to build a company around that product. In some cases, it's freedom from constraints of having been too close to the industry. There's a great quote that I have in the book from the CEO of Southwest Airlines, which is a low-cost airline provider in the U.S., a guy named Herb Kelleher. He was a lawyer by training, and when he decided to start this airline business, he was asked, in a fairly rude way, what makes you think that you can actually run an airline business? And his answer was, because I've never actually run an airline business. And so in some cases, maybe having the freedom of the constraints of knowing too much about the business is a better way to go. But we talked about storytelling. The whole question with entrepreneurs at the end of the day is, do you believe that they have enough strength of conviction, they will kind of walk through walls to get things done, they have enough of a storytelling capability to be able to attract people to come work with them and want to kind of follow in that leadership path? And then hopefully, is there some appropriate malleableness over time that as they get information from the market or otherwise, that hopefully keeps them on the right path?
And you talk, I think, at one point about the need to have strong opinions weakly held. Can you just elaborate on that and some examples of people who have had those characteristics and managed to pivot their businesses in a successful way?
Yeah. So what we mean by strong opinions weakly held is there's the kind of failure case, which is, if you come in to pitch us and in 10 minutes we can convince you why your idea doesn't make sense or why your go-to-markets, it doesn't make sense, that's probably not that's not going to end well, probably, right? And we don't want that, right? We don't want people who are so malleable that they believe that we know more about their business than they do, which is clearly not the case. But what is the case is we know that from a product perspective that until you get a product into market and until you actually get real feedback from real customers, you're kidding yourself if you really think you know exactly how you're going to nail product market fit at the first time. So you can't be so entrenched in your views that you aren't willing to kind of take new information that comes in the market that's rational and allows you to kind of pivot your product direction one way or the other. So that's what we mean by that. And so it means the appropriate balance of being willing to listen and willing to incorporate new information, but also having enough kind of confidence and having done, of course, enough research in your own background that you understand kind of what your starting point is.
And are there any of the successes that you've had as a firm where you can point to somebody sort of pivoting the business model at the appropriate moment, having the flexibility to realize that the path they're on isn't maybe quite right and they need to change it significantly?
Yeah, we were lucky enough to be part of, I would say, probably the pivot of all pivots, which is Slack. So Slack, as many of you know, is a communication software company that recently went public. And what we funded originally was not Slack. We funded, actually, the company was called TinySpec. And what Stuart Butterfield was trying to build was a massive multiplayer online game. The interesting irony of that is this was the second time he was trying to build this game. So when he built Flickr originally in the 90s that got sold to Yahoo, his original pitch that he pitched VCs was to build this game. And he kind of realized partway through there that it wasn't going to be successful, and so he pivoted to Flickr. In our case, he kind of pitched us, he's like, look, this is now my time to go build this game. He built this wonderful game for any of you who
Does he still want to build the game? Yeah. Anyway,
no, these guys built it. And it turns out, the game was beautiful, but he kind of finally realized it wasn't a business. It couldn't kind of sustain it as a business. And, they had a couple months of cash left, and they said, hey, look, we built this kind of internal communications tool that we use in our engineering team. Is it okay if we basically see if there's any legs here in the market? And lucky for us, we were, kind of smart enough not to say no to that question. But, those things don't always happen where you go from kind of, a few months of cash left on the balance sheet to ultimately becoming a public company. But, if you think about that, though, the reason why it's not so crazy is ultimately what we invested in was Stuart, right? That was really the thesis on that original investment. We had no idea if that game was going to work or not, and nor did he, understandably so. And we didn't know, of course, that he would, do this incredible pivot. But it goes back to why team and people is just so central to the investing themes in these companies is if you bet on an incredible founder, you're betting on their kind of vision, their ability to kind of figure out what's working, what's not. And then a lot of what we need to do is kind of get out of the way and let them do their thing.
How much, again, without wanting to dwell on SoftBank too much, but one of their pitches is that because they have this amazing portfolio of companies, that there's sort of interplay between them and they can help each other, and that network is a positive. You obviously have a lot of companies as well. I mean, does that network really help? Is that something that people should be thinking about when they take money, that they want a VC that has that network, or does it not really matter?
I think it's very situation specific, which is the network of companies they have actually companies that are relevant to your business. So many years ago, Kleiner Perkins, which is a very well-known VC, obviously in the Valley, they used to call it the Keiretsu after obviously the Japanese model, where they were doing a lot of that of kind of cross-pollination among their companies. And I think for some companies it was highly valuable, but for others, it's not obvious that's your target client base, right? So I think what's probably relevant, if I were looking at VCs, is okay, if they can help me get customers through that customer base, that's wonderful. That's my target market. If not, I'm probably more interested in, can they get me access to customers outside the portfolio that are actually, kind of more relevant and more, sustainable for my business.
And how do you feel about choosing between having one very dominant investor versus having multiple investors where they, obviously it's simpler to have one, but obviously they have a much stronger voice in their ability to push you around. How should you think about balancing that as an entrepreneur?
Yeah, I think it's also, I would say, a little bit stage dependent. So in the US, what's happened is at the early stage, with the exception of seed, where there still often can be multiple players, when you get to kind of a traditional A round or a B round, generally there's no syndication. You're generally talking about one major investor, and there might be some other kind of minor investors. And I think that's just an economics question right now, which is the founders, to their credit, have gotten smart enough to recognize, look, I don't need to sell 50% of the company at the A round. I can sell 25%, which is sufficient for the ownership requirements of the VC, and then I can go get another VC if I want it to B round. So I think you tend to see kind of these staggered kind of additions, which is you have one person at the A, maybe one new person comes in at the B. Look, I think if you like the relationship and you think that company can scale with you, there's no reason not to continue scaling with them if you know they're performing for you. You know, I think there is value over time in having more diversity around the board table, just to make sure that you kind of have different views being represented. So in general, what you do see is as companies get more mature, is you have kind of multiple VCs coming in, and therefore different people are being represented on the board.
And as a founder, obviously there's the valuation, there's the fit with the company and the culture and everything else, and what they can do to help. What else, as you're sitting looking at a term sheet, should you be focused on? What are the pitfalls that you can get wrong if you're not careful in the small print?
So a couple things. One is, in addition to those two, I think you have to think about the governance aspects of the relationship that you're entering into, right? So remember, you're taking a partner that may be with you for 10 or 12 years, and in addition to getting their money, you are now kind of letting them under the tent, right? So they're now going to be able to vote on things like, should we raise more money at some point in time? Should we take the company public? Do we want to sell the public? And you have to understand the trade-offs and the implications of that, because you may decide, look, this is my business, I don't want input on those things, and it's probably unusual in a venture context that you're going to get away with that. And so you have to decide, is access to capital worth taking on that stuff? The other big thing, which I would just talk about on the fundraising process, is I think people often don't think critically enough about the right amount of money to raise at a particular round, right? Often it's kind of a little bit of heuristics. They're like, hey, the last 5 A rounds I read about in TechCrunch, were $10 million, so I should raise $10 million. The best advice I think we always give to entrepreneurs is, when you're raising the current round, you want to think about what's the story you're going to tell at the next round of financing, and then effectively work your way backwards to figure out, okay, if I'm going to achieve those milestones, how much time do I need, how much capital do I need to be able to de-risk my opportunity to get to that next milestone? And that's a lot of actually what the VCs are thinking about too. If we do an A-round investment, we're thinking about, okay, if we set the valuation too high or too low, or we raise too much money, what is that B round going to look like, and are we raising the hurdle too high in order to be able to kind of achieve that?
But isn't there a temptation also to say, well, I'd rather over-raise, because as we've all know, we've seen cycles, and the thing shuts down periodically, and if you happen to be at the wrong place in the wrong time, you can plan this beautifully, but then run into a wall. So how should people think about,
I think, so you're right. I understand the temptation. I would say, at least from the experience we've seen, the two big problems of over-raising are, number one is you significantly increase the hurdle for the next round of financing. And look, if you're confident that you can get there, and I would expect founders to be confident generally, then maybe that's a risk you want to take, right? But just recognize that if for some reason, things don't go exactly as planned, you might find that at that next round of financing, you've got something worse to deal with, which is potentially either a down round financing, or potentially, kind of somebody, people just don't want to bid on it. The other thing I would just think about too is, you don't need to, everything doesn't need to be completely scarce, but in general, what we've seen is when you raise too much money, it's very hard to put a governor on spend, right? Because, it's very hard for you to go to your employees and say, hey, ignore the fact that we just raised $50 million, we're still not going to hire those people you want us to hire, right? So it becomes a very hard constraint that is no longer there. And look, if you're the CEO who can do that, who can kind of raise more money, hit your milestones, and also constrain your spend in a way, then that's wonderful. Go do that. I would just say our experience is that's often not the case.
So there's a question here about negotiation. What is your style of negotiation? What would you recommend for beginners in negotiation? And I would just add, sort of how much room is there for negotiation when you go into these conversations?
Yeah. So look, the best advice I can give any entrepreneur with negotiation is, look, negotiation is always a function of the relative kind of strengths and of the respective parties and the alternatives you have. So the best thing that you can do, and most entrepreneurs do this, is you should talk to more than one VC. You should see if you can obviously generate interest there. That's the best way for you to both keep the process honest as well as to give you some leverage on negotiation. There's always room for negotiation on these deals. At some point in time, right, there is some percentage ownership that a VC may decide I'm not willing to go below. There's some amount of check size they may not be willing to write, or there's some issues around governance they may not be willing to cross. But those are all things that you can elicit in the discovery process. And I think, you should think of those as not necessarily, nobody's sitting down with surrounded by lawyers with people yelling at each other. These are often, single, person-to-person kind of conversations where you can solicit this out.
During these negotiations, should you be trying to build a rapport like you would when you're dating someone ahead of marrying them? Or should you be, you know, non-exclusive, playing off two people against each other and see who comes out on top? How's the best way to do that?
I think you should be transparent with the person you're trying to get to deal about, okay, what is it that would make me want to do this deal? So, you know, kind of, am I your first choice? Do you want to work with me? And if so, let's figure out, is there a set of parameters we can both agree on? Now, look, obviously, yes, you would be silly not to at least have some backfall in case that doesn't work out. But I think it's very hard to kind of, I've never seen anybody literally simultaneously kind of, you know, doing two negotiations at once. So often these things are serial, where you say, great, I know I've got enough interest now. I think I've identified the party I want to work with. Let's give it 24, 48 hours to see if we can get there. But I think it's about, you know, being transparent on the entrepreneur side and also the VC being transparent and saying, look, I can live with this and I just can't live with that. And I think you'll find that most people are actually, you know, pretty open on that process.
So I quite like this question. What importance do names, I assume that means brands, have when people come in? I mean, do you care what they're calling their company? I mean, it sounds like a lot of them change anyway. Slack, obviously. What did it start out as?
They started as Tiny Spec was the name of the company.
Spec.
That was the name of the game.
Do you care about that, or is that just an irrelevance?
No, I don't care.
Fine.
Okay.
There you go. If you started a first-time Silicon Valley-based VC today, 100 million or less, what would you do better? And what LPs are best for starting and building a team, I think is the question.
Okay.
So, i.e., just, you know, how would you think
Okay,
about
yeah.
Building a VC today? What would you have learned from your own journey?
Yeah, so the good news is there is a lot of new fund formation, particularly at that category, in the kind of sub-$100 million category. In the US, I think the numbers I've heard is something like 800 new firms over the last 10 years have been started in that category. So there's lots of things happening there. And the good news is traditional institutional LPs are now funding those. So it used to be that it was mostly individuals and families. Now, you know, the same kinds of LPs that might invest in bigger firms like us are also investing in those. So look, I think the best advice is that I would give you is it's the same in your own business, which is what is your differentiation in the market, right? So assume entrepreneurs have choices, which they do. Why is it that an entrepreneur will choose to work with you? I think that's the question you have to be able to.
Are we out of time? What's happened?
Did I say something? Oh, there we go. Okay. I hope I didn't offend anybody with that. But I think that's the fundamental question. What the LPs are going to want to know is there's 800 of these other firms out there. Why are you going to be able to convince an entrepreneur to work with you, to be able to find the deal flow, and then ultimately add value? If you can't answer those three questions, then you know, with confidence, then you probably shouldn't be in the market for raising a fund.
And just to follow on from that,
Yep.
I mean, if you look back at your own career, building the firm, looking at investments, what are some of the biggest mistakes that you've made that you would be able to learn from?
Yeah, so I think there's a couple of things. So let me split it out, which is there's kind of mistakes of commission and there's mistakes of omission in our business, right? And the mistakes of commission are, you know, we invest in something that turns out not to be a successful company. And that's no fun, and nobody likes to lose money, but that's the nature of this business. So if you look at historically over the last 30 or 40 years, about a third to a half of what VCs invest in ultimately, we use this very polite term that's called impaired capital, which basically means you lost all your money. You screwed up and lost all your money.
And you call it impaired?
Impaired, yes. It's a very polite way of saying it. Maybe it's a British word, actually. Maybe that's why it's so polite. So, look, that's no fun, but if you believe the process by which you made that decision is a good process, then even if the outcome is a bad outcome, that's okay, and I think you don't want to beat yourself up on that. The mistakes of omission are very, very hard because, you know, we know this is an outlier business. We know there's only going to be 10 to 20% of our companies that are going to ultimately get to some kind of scale like a Facebook or a Google or an Instacart or Airbnb. And if you miss those, it's very hard to make them up. So I think the mistakes that we make sometimes are these market size mistakes where we don't allow ourselves to be inventive enough to think about, okay, could Lyft create a new market of scale that didn't exist before? Could Airbnb turn people from couch surfing into actually being a replacement overall for kind of, you know, quite frankly, you know, broader travel and hotel? Those are the mistakes that I think we look back on and we realize we need to kind of be more aggressive in being willing to accept that technology can move markets and change market sizes. And if we think the team is the right team, then we ought to make those bets as opposed to kind of the omission mistakes.
And just going on back to your impaired companies,
Yes.
I mean, obviously, the companies that succeed nowadays can get enormous very, very quickly. Have you seen the sort of percentage of impaired to successful shift over time? I.e., is there any sort of sense that you're placing more bets because they're more outsized when they win, and hence you can take more impairment, as it were?
It's interesting enough, so at least, obviously, we've only been in the market for 10 years, so our data is not great, but I've looked at the data from a couple of our LPs over time, and it turns out that this is pretty consistent over time, which is about a third to a half of the portfolios, of the companies in a portfolio end up in this impaired category. And it's actually very interesting if you look at the data, which is the difference between a good venture firm and a not good venture firm is not that delta between a third and a half, right? They're almost all the same. The only question is, what's in that final 10 to 20% bucket? Do you have some outlier that gives you 10, 20, 50, 100 times your money? And if you have that, quite frankly, the impaired capital doesn't matter at the end of the day. And if you don't have that, no matter how much you've managed to not impair your capital, you also can't get to a high returning fund.
Okay, so we're going to keep going with some of these questions. I do want to, though, offer people, I don't know if you're all Slidoing on your mobiles, but if anybody does want to put their hand up and stand up and ask a question here in the room, do feel free. So why don't we go to a couple in the room? If we've got a microphone, there's a lady here, and actually there's quite a few. So we will go to them now.
1, 2, 3.
Well, okay, off you go.
Hi, thank you so much for joining us. I just wanted to ask what percentage, if you can share, of your fund is female founders or founding teams that include females?
Yeah. In our funds, female founders is about roughly 15%. That includes mixed, by the way. That includes female only and kind of mixed female and male funds. My understanding, at least of the data across the broader ecosystem, is that's probably generally in line. Like the number that I think we often hear quoted, which is obviously an incredibly low number, and I don't mean low like it's not believable, it's just a bad number, is 2% of funding, at least in the US, I don't know if that's true globally, goes to kind of female-only founders. Look, I don't think we haven't solved that problem at all, but at least I think we are kind of, hopefully doing better than at least that number would suggest.
Anyone else?
Someone in the front here.
Okay. You.
And then we'll go to the man in the green shirt.
Hi, thanks for attending this event.
Thank you.
I just want to know, the VC model has been around for about 50 years, and people say it's quite out of date, quite stale.
Yep.
While everything else is evolving, the technology and so on. Any hints of it changing in the future?
Well, so I actually, I think what you're describing was actually true for up until about the last 10 to 15 years. So you're right. If you looked at kind of early 1970s to kind of about 2000, which is most of the history, at least, of kind of, particularly the kind of US-based venture business, which was most of the business at that time, you're right. It was a weird industry, which is we invest in these incredibly innovative companies, and the industry was incredibly staid. It never actually changed. The big things that changed over the last 10 to 15 years are, number one, is the whole institution of seed, which I know sounds kind of crazy for people who are living in it now. That really didn't exist before, right? So we used to just have angels. We had individual people who would write checks to companies. This idea of this kind of magnitude of seed funds, as I said, 800 of them over the last 10 years have been started. Like, it's pretty amazing how that's changed the industry. Because if you think about that, before those seed funds existed, all the traditional A and B round early stage funds were first institutional capital into the business. Now you have this whole set of, in this case, 800 plus funds that are kind of disintermediating effectively, a lot of those traditional funds, and that's dramatically changed the competitive environment for the business. And I think that's what's forced us and all the other venture firms who want to compete to recognize we have to have some differentiation in the market. Capital alone is not going to differentiate us anymore. We have to do something that's attractive to entrepreneurs that makes them want to work with us. So I think that's dramatically changed. I think there's no reason to believe the business won't continue to change. I think some of it may just be a maturation of the business. We're now going into 50, 60 years almost of the venture business. And so I think you will see this. I think, capitals continue to be very much a commodity. I think, personally, I think we will be in low interest rates environments for a very long time. And so I think the bar will continue to raise, which is entrepreneurs will have choices and VCs will have to figure out how they compete for that business.
The gentleman here, and then we'll go back to you guys.
Hi, I'm Asher from Airv. Do you prefer to invest in companies that are in Silicon Valley, or to add to that, do you invest in companies that are far away from Silicon Valley?
Yep.
Second question, comment on the age of entrepreneurs. Do you invest in entrepreneurs in their 40s and 50s as well as in their 20s?
Yeah, absolutely. On geographic,
It's a good question.
So the first question was geographic. So for us, about 75% of our investments today are in Silicon Valley, about 90% in the US. We've got a few investments here, TransferWise and Improbable you may know of here in the UK market, and then we have a couple investments actually in Latin America and Israel, but call it roughly 10% of our portfolio. As I mentioned earlier, that's not a normative statement about the attractiveness of those markets. We still feel like we are perfecting the business. And so I would expect that over time you will see us do more in other markets, but we want to do it in a way that's brand consistent. So I think that's just a timing question for us.
Just on that, what do you think about London in terms of VC? Do you have any more to add on that, or?
Look, I mean, from what I see, and I admit I'm not, on the ground day to day. Look, I think the market is in a very good spot right now. So I think, again, the critical thing to me, I think, is you have to have early stage capital be local capital. I think it's very hard to assume that you can have an ecosystem grow without having kind of seed and relatively early stage, call it A and B round financing. The later stage capital is quite efficient and it will travel. So if you didn't have, kind of people who could write $50, $100, $200 million checks, that capital is very efficient. And so I think you can support a market there. And my sense is, look, I think, the London market is very strong in terms of its early stage capabilities. It's very strong, no doubt, in terms of its engineering capabilities and product capabilities. And look, obviously there's Brexit and all these wonderful things that we can talk about that are potential overhangs, at least in the short term. But I don't think there's any reason to believe that this market shouldn't continue to grow and be vibrant. You asked a question, so I just want to answer your question about age of entrepreneurs. The answer is we have both inexperience and experience. I prefer to use that term rather than age. I will say in the Valley, if you look at it, probably I would say on average the consumer companies skew younger, more experienced in terms of the founders. The enterprise companies, interestingly, used to skew much more experienced. Now, as we've seen more of some of these kind of bottoms-up, kind of almost consumer go-to-markets in these enterprise, particularly the SaaS companies, you do tend to see, kind of I would say not the same skew all the way as you do on consumer, but I'd say probably a more inexperienced skew on enterprise than at least if you looked at the data probably 10 or 15 years ago. I don't know, by the way, the exact percentages, so I'm not trying to avoid your question. I don't know the number. But then we also have a number of, kind of second and third time founders, and we like, kind of backing folks like that as well who've kind of been through it before. So I'm sure people. I don't want to be Pollyannish and suggest that there aren't ageism or other issues that we have to worry about in this business. I think in general, though, people are pretty open in this business to kind of what is the idea, what is the kind of team behind it, and if through experience you bring something that a younger, more inexperienced founder wouldn't have, then I think most VCs are pretty open to that.
There were a couple of questions here.
Hi. What have been the biggest?
Oh, hi.
What have been the biggest lessons in corporate governance, and how has this impacted the way you invest in companies?
Yeah. Wow, what a great question. Did somebody plant that question? Because I love corporate governance. It's one of my favorite topics. I mean, look, what's happened over the last 10 to 15 years is a direct reflection of, I think, of this kind of changing balance between the entrepreneurs and the VCs, right? And for the most part, that's been a very, very positive thing, which is, as I said, entrepreneurs have choices now. They have way more ability to kind of get what it is that they want out of venture capitalists. One, I think, negative consequence of this has been that, yes, we now have, I guess I would say, looser forms of governance than probably we historically had in the business. And really, you see that mostly manifests itself in the board composition for these companies where you have, again, most of the companies in Silicon Valley are common controlled boards, meaning, the founders, kind of control the board. That's kind of that's the nature of the way things are today. I don't know whether that will persist for the next 10 or 15 years, but that's kind of the state of the market where we are today. I think what that means is we have to do a better job as an ecosystem of kind of what I would call power of persuasion governance as opposed to kind of legal governance, which is we probably don't have the legal rights and stuff that, kind of people might have had 10 or 15 years ago because of these board constructions. But we've got to do a better job of helping the companies understand, what is appropriate and what's permissible from a governance perspective. And look, I think there's definitely work to do there for sure in the industry.
I think, was there another question next to the lady that wanted to still ask one? Yep. Do you still have the microphone? Yeah. Is it gone?
Repeat it for you. Yep.
So crowdfunding sources of VC funding?
Yeah, so, it's interesting. Crowdsourcing, kind of was, I would say, was fairly popular, particularly in the U.S. when this thing called the Jobs Act came out, which was basically Congress's way of kind of making it more permissible. It hasn't really grown that much, to be completely honest, right? So I forget the last numbers I saw, but you're talking about maybe $1 billion, $2 billion or so relative to last year, kind of $100 billion plus of investment. So it hasn't materially grown. Some people, I think, thought that kind of the ICOs, the initial kind of coin offerings that we had in 2017, which were, effectively a way to think about another form of crowdsourcing. So these broad sales to many people to raise capital for crypto companies would be kind of the next iteration of crowdfunding. If you pay any attention to that in the U.S., I think what you've seen is the U.S. regulators have largely said that, look, that's not permissible, you can't do that. So I don't want to suggest that crowdfunding won't be more important. It seems like it should, which is the whole idea of democratization and access to capital is a trend that you would imagine will grow over time. I would say right now, people maybe just people haven't figured out the right mix yet, because it hasn't really taken off in a way that I think people expected it might, 3 or 4 years ago.
I'm just going to do a quick question from the screen while people think about other questions. We will come to you, I promise. Just give us 1 second. What's it been like working with Mark and Ben for most of your career, and how do you complement their strengths or weaknesses?
We're not being broadcast to 20 different countries, right? This is just between us and
just between us and the front row.
The
for sure.
150 people in this room. Look, I don't want to be mean to them, and I don't want to be sycophantic either. But look, what to me is most amazing about them, and this is true for anybody who's worked with them, is they are constantly thinking about new things, and some of those admittedly are ideas maybe that we shouldn't be doing, but they don't, I was trained as a lawyer, and lawyers are very focused on precedent, right? So precedent is really a lot of how you become a lawyer, at least in the US. I don't know whether the legal system here is different. I wouldn't say they completely ignore precedent, but their view is, look, everything should be argued from first principles, right? So just because something was done this way before, why is it that we now do it now? And that could be everything from, could Instacart work in 2019 when Webvan didn't work in 1999, or things of that sort, to, kind of just because it's traditional that, companies go public at some certain time or certain age, maybe we need to rethink all that. And so to me, that's the most amazing thing. I mean, I've been working with them for almost 20 years now, is you can never come to work and feel like, okay, you're done and you can just kind of coast through the day. There's always some new question, and it always requires like incredible level of kind of depth and thought process. So to me, that's kind of the most exciting thing. When I first took the job, actually before this one, I worked for them at LoudCloud, which was a 1999 company. I remember going home that day, and I told my wife, I think I'm going to quit my job. I was working at an investment bank at the time. And she said, well, like, why would you do that? And I said, look, I have no idea if this thing's going to work, but it's going to be fascinating. I'm going to learn a bunch. And that's still true today. So I feel very lucky to kind of be.
And you went on the back of them as individuals.
That's right. Yeah. I mean, it was basically, look, I mean, they started the company. I interviewed with them. They started September 99. I interviewed in October of 99. There was no business, but there was this vision to build, we were trying to build Amazon Web Services. That was basically the kind of vision for the business. And we were, unfortunately too early, which is often the tale in a lot of these venture businesses. But yeah, that's what convinced me. Was I sat down and Mark basically sketched out on a napkin in a restaurant, kind of in California, how we were going to conquer the world with this new business. And it was kind of willful suspension of disbelief, I guess is the way to describe it.
I guess you made a good judgment, so congratulations.
Well, thank
so
you.
There's two questions here. We've got 5 minutes, so we'll try and get to as many of you as we can. But the lady here by the bar, hopefully with a drink.
One, two, three.
Thanks. Sorry, not with a drink, but moving on nicely from your last question about law, about you as a lawyer, so legal tech. So you guys have obviously invested in Atrium. Why do you think that legal tech companies haven't exited so far, and what's your sort of view on that as a market as a whole?
Why haven't they exited? Is that the question? Yeah, we have another company called Everlaw, actually, which, for those of you who are lawyers, deals with kind of the discovery process in litigation. I think they haven't exited yet just because, look, for those two companies, they're still just, quite frankly, relatively early in their journeys. It seems inevitable that, a business that is a very kind of human and labor-intensive business ought to be able to benefit from software and automation, particularly, again, for any of you who are lawyers, the discovery process, as we know, is an incredibly time-consuming process. So, again, I don't know if I have a great answer other than they haven't exited because they're still in development stage. Yeah, you're right. It's been slow. Look, partly, the legal profession is a very heavily regulated profession. I don't know about it here, but in the U.S., for example, a big prohibition has been that non-lawyers cannot be equity participants in a legal practice, and so that's made it very difficult for kind of people who are otherwise business-minded, who are not lawyers, who want to kind of apply automation and new business models. Atrium has kind of, adopted a new strategy to try to deal with that by effectively marrying a law firm inside of a technology company, and I think that's a very interesting approach. So I think maybe that may be part of it. It's just we're at the relatively early stages of kind of this industry going through some automation and maturation.
The mic was hijacked on the way. Congratulations. Go for it.
Don't worry, I'm going to give it back. So thanks again, guys, so far. A question that I had for you, Scott, is how often, once you've invested in a company, you guys have provided them funding, how often does then a company, say like midway through, turn to you or your advisors or your team to say, shit guys, our pipeline or the lead generation, sales and marketing strategy that we're working on isn't going to plan. Can you help us?
How often do they say, kind of, oh shit, we need help?
Yeah.
Sorry for, look, it doesn't usually work that way. So in other words, I would say it's a more, yes, there's a couple times that happens. It's often a more organic process, which is we try to be engaged with the company on a regular basis, right? So we'll have a board member who's going to board meetings and meeting with the CEO probably regularly. We do have this whole team that's interacting quite often. So it's not often kind of we have kind of this, oh crap moment. It's much more that over time kind of, there are issues that we see in the performance of the company, and often the company sees itself that may then cause us to say, hey, let's have a sit down and actually try and see if we can figure this out. But it tends to be more organic like that, as opposed to, it's not like we put the money in and then we kind of disappear for 2 years and then they come back to us and they say, oh, by the way, we're in trouble now, can you help us? It tends to be a much more engaged and ongoing process.
So we're going to do 2 more questions. I'm going to do one from the board and one from this gentleman. Oh, there's too many. Okay, we'll do one from the back as well. If you don't mind, we'll run over a little bit. We'll do 3 more questions. One from here, and one from the back. What would be your one takeaway on what not to do when scaling a business as you did?
What not to do when scaling a business? Mess it up.
Very good. Okay. The gentleman by the bar, and then we'll go. There was a lady who stood up, very keen at the back. We will go to you afterwards.
Oh, that was your question.
Sorry, I've got the microphone.
Oh.
Okay, so that was the same. If we could go to the lady at the back who stood up, if you could stand up again.
Hey, sorry, can I ask a question?
That's a different question, sorry.
You said at the start that you don't believe this is the end of the market cycle. I was just wondering if why? Why don't you believe that?
How much time can we go over? So look, I'll give you my very quick answer. So first of all, look, let me be totally clear. I'm not a macroeconomist. I have absolutely no idea is the honest answer, okay? That won't stop me from now pontificating on it. Look, I think that particularly when I look, and again, we are largely U.S.-oriented investors. So when I look at the U.S. economy and I try to kind of disaggregate what's happening in terms of consumer spend and employment rates and inflation rates and in business spend, I think modulo this kind of big Chinese-U.S. tariff question that's overhanging the market, I think we're actually in a relatively good place. We're not going to grow 3 or 4% a year, but I think we actually have a reasonable chance of continuing to grow at, call it 2.5% a year. So my personal view is that we will, if we get a macro shock like that, kind of obviously all bets are off. But I think from a fundamentals perspective, I actually feel reasonably good about where the economy is. Now, look, there's lots of other things going on in the world, of course, that matter too. But I think at least from that perspective, there's no reason other than, in my mind, other than the passage of time that we are now in an expansion that people automatically assume that we must therefore be coming to the end of the expansion. You got to keep in mind, right? We've never had. I promise I'll wrap up. We've never had 2 basically back-to-back financial crises in a very short period of time in history like we had before, right? So the 2000 crisis followed by the 2008 crisis, it has left indelible marks on all kinds of how people think about the industry and the market and stuff like that. And that's not to say that, kind of everything will always be well all the time, but I still think, kind of the impact of those shocks is still being felt. And so therefore I think people are kind of consistently worried that, like it therefore must come to an end. It's not obvious to me that a business cycle comes to an end unless there is either a macro shock or some of those fundamentals change.
So we have been shut down, I'm afraid. So we're going to have to end there. But I apologize to you at the back. We tried to get the microphone to you, but it was hijacked a few times on the way. But do come and talk to Scott and ask the question in person. I think he'll be here for a few minutes signing books and other things. But thank you all very much for coming. And Scott, thank you for fantastic talk.
So this is, please give me 2 minutes, 2 more minutes. Thorold, this was awesome. Thank you so much.
Oh, good.
Lovely. Scott, thank you. Thank you. Now, please give us 2 minutes. We have some more information for you. So we would like to tell you, excuse me, please, we are not finished yet. All right, so we do these every single month in all those cities where we are based. And we are based in 500 cities around the world. So if you travel, you want to meet some people, feel free to pop into Startup Grind. I would like to say big thanks to Scott, to Thorold. We have learned a lot from them. And you can also watch the videos afterwards on our website if you want to see some more parts of the video. We want to say thanks to our partners, to our global partner Heroku, who helped us put this together. We want to say thanks to our London partners. We have 2 companies which I would like to especially say thanks to. One company is our law firm which we work with. We also use this law firm. It's called Lewis Elkin. Please raise your hand where you are so we can find you. So if you have any questions regarding term sheets, raising funding and so on, for free, they are here to answer them. So it's super useful. Second company I would like to say thanks to is a company called Hardsoft. Please raise your hand where is Hardsoft. We have 2 amazing people. Andrew, the founder of Hardsoft, which is a company which is now of a decent size. And what they do is, so we have Andrew and Sophie, and they help fast-growing companies not to have to pay for your equipment like computers, mobiles, and so on, but you can lease them. So we don't have to pay so much cash upfront. They're working with Apple and so on. What I love about this company is that, for example, if you do that, you can every year get the newest upgrade, which is quite awesome. So free to reach out if you want to. I want to say thanks to our team. And we would not be able to do this without these amazing people. And we are here to help you. So if there's anything we can help you with, you're looking for a co-founder, you're looking for a CTO, you would like to get connected with some good designers and so on, our team can help you. So please feel free to find us. Guys, please raise our hands where we are. You can see us throughout the room. And the last slide, I think this is it, right? So Scott is kind enough to do some book signings here. So if you're lucky, there are not too many books here. You can come to the table and Scott might be able to sign the book for you. And both Scott and Thorold are going to be staying behind for 10-15 minutes, so you can also say hi. Please, if you do, be respectful and don't take too much time with them, because let's make sure we can also have other founders speak to them. Thank you for coming. We have super interesting people in the room. Feel free to say hi to each other, have a drink, connect. And next time we have an event on the 20th of April, so 20th of November. So see you next time. Thank you for coming.